Hello and welcome to our third video for Module 2. Our topic in this video is all about the basic investment structures. So how should investments be structured? Now there isn't a one-size-fits-all answer for this question. It all depends on the individual circumstances. And before purchasing assets for investment, it's important to consider the investment structure to use. So who is going to own those investments? The legal owners, they could be individuals, partners, companies, or trusts. These are the structures that we could use for the ownership. So it's important to take some time and think about the investment structure options before investing. If you get it right up front, it's a lot easier than trying to fix something at the end when you've made a mistake choosing the investment structure. So what do we need to think about before choosing the investment structure? Well, we need to think about who should receive the income now and later on in the future. Who should receive the capital now and in the future? Do we need to protect these investments against potential future creditors? What about family circumstances? Is there anything there that we should consider about who should own assets and receive income now and in the future? What level of flexibility is needed when we're thinking about debt and leverage? And what are the tax implications for each structure? And what estate planning issues need to be addressed? So there are quite a few issues that you need to think over first before choosing the investment structure that will best suit. So these are our choices. We can choose between individuals, partnerships, companies, trusts, and superannuation. And we'll look at each of these in turn. So first of all, the individual. This is the most common. I know quite a few of you are owning shares and investments. So this is probably the way that you've got it set up at the moment. So you own the shares or whatever the investment is in your own name, either singly or jointly. It's very easy to set up and manage the income that you receive. For example, if you're getting any income through dividends on your shares, and if you sell them and you have a capital gain, then you put it through your own individual tax return. So it's very simple to manage it. Very easy to administer. There's a lot less paperwork compared to the other structures. You've just got to keep track yourself of what you paid at the beginning and keep your paperwork. Very cost effective. There's no extra cost to setting up and running, and quite tax effective, especially if the investment is negatively geared or the owner or one of them is a low income earner. There are tax advantages if the investment is the family home. So if you're an individual owning the family home, then you don't have to pay capital gains tax when you sell it. But there's no flexibility on distributing the income, and your assets are exposed to risk from creditors. That's the investment structure of an individual. Let's go and look at partnerships. So this is quite a simple structure, fairly low cost to set up. It's a separate entity for tax purposes. So the partnership has its own tax file number, lodges its own tax return. The partnership itself doesn't pay tax. What it does is it splits the income between the partners according to the partnership agreement. So there's limited distribution flexibility there. There's no risk protection. The assets of either party could be subject to claims by creditors. Partners are jointly and severably liable. So that means one partner could end up owing all the, personally liable for all the debts of the whole partnership. That's partnerships. Let's have a look at companies. This is a very common structure you would have heard of for business. You might not have heard of using it for investments. But when you're using it for investment, the main benefit is that the company tax rate is much lower than the high marginal rate. So if you're on the high marginal tax rate paying 48.5%, then the company tax rate, 28.5 or 30, depending on the size, would actually be more tax effective. It gives protection for shareholders if the business fails or is sued. Losses can only be offset, though, against future income within the company, and a company is not able to obtain the benefit of any capital gains discount on the sale of investments. So remember, as an individual, if we, say, for example, own shares and we own them for more than 12 months, then after that period, we would get a 50% discount on capital gains tax. The cost of setting up a company is high, and there's a requirement separate set of financials and a tax return each year, and there are ongoing asset registration costs. There's quite a lot more paperwork and cost involved in a company. So you can distribute profits by paying a dividend from a company, but it's got to be in accordance with the shareholders. Our fourth option is trusts. This is quite popular. It could either be a natural person or persons or a company. So the trustee is allowed by the trust deed. It depends what the trust deed says as to which of the beneficiaries, what proportion of the income and the assets are distributed. So if they've made a profit, franking credits can also be distributed to the beneficiaries. And we love franking credits. A trust cannot distribute losses, but they can be carried forward to be offset into the future income. So the three main types: discretionary. So that means that they're able to distribute income and capital gains tax to beneficiaries in whichever way they desire. So usually they'd pick the most tax effective. And assets are protected in the case of litigation against the beneficiaries. So if the beneficiary is being sued, these assets are being protected within the trust. And beneficiaries who receive capital gains can claim the 50% capital gains tax discount. A unit trust, so that's where the assets are held and administered by the trustee for the trust for the holders of the units of the unit trust, and there'd be predetermined unit holder entitlements. And then we have a hybrid trust, which is a mixture. They're trying to take the advantage of the best features of both the discretionary and the unit trust. Okay, so those are the main four you've heard of, but don't forget about the fifth one, superannuation. This is actually a special type of trust with a unique set of rules. So it's not an investment in itself, but it's an investment vehicle. We would all be fairly familiar with this. If you're working, you've probably got a super fund. The super fund only pays 15% tax on the net income, and sometimes no tax at all if the members are in pension mode and they're under the thresholds for owning the assets. Now, the main disadvantage is that there is the preservation. You can't get hold of your superannuation until you're reaching your retirement age. That does, however, come faster than you may ever imagine. Not that I'm anywhere near that yet, but I can see that in the future. And it's really important to protect yourself for your future. So our investment structures: individuals, partnerships, companies, trusts, and superannuation. I hope that wasn't too much information and you're not too confused. If you've made it this far, congratulations. Investment structures is actually an important part of our case study. There are some marks for discussing the different types of investment structures and what you suggest for the client. Okay, that's it.